3 tips on how to stay invested through turbulent times. Tip 1. Be aware of how the human mind responds to complexity. Volatile markets and complex news flows often cause the human mind to go blank and can easily lead to irrational decisions. It is important to take a step back and separate the noise from the fundamentals. To demonstrate this principle, try to answer the following questions. What is 2 plus 2? What is 62 plus 48? What is 32,765 plus 69,561? The first question was easiest to answer as it's part of our memory. The third is complex and needs to be calculated. Most people are overwhelmed by this complexity and think it is impossible without a calculator. Only after taking a step back does your mind allow you to tackle this problem, just like we learned in primary school. Tip 2. Minimize behavioral portfolio management mistakes. To minimize the availability bias, investors should review the performance of funds over its appropriate time horizon and consider its long-term track record over complete investment cycles. The availability bias is believed to be one of the most common biases in investment decision-making. This mental shortcut assumes that if something can be recalled, it must be important. However, it is usually the most recent or the most traumatic results that we remember first. To demonstrate this, answer the following question without using Google. How do you believe the JSE All-Share Index performed in the following years? Did it go up, down, or flat? Most respondents believe the benchmark to have been either down or flat in the years following the Great Financial Crisis. The index actually saw double-digit gains in 2009 and 2010, and a modest gain in 2011. Painful memories affect decision-making even when the event is over. An investor with a horizon of 5 years invested in a multi-asset high-equity fund is likely to compare the recent short-term performance to that of multi-asset income funds. Dramatically, multi-asset high-equity funds have underperformed income funds over a rolling 1-year period 84% of the time over the last 5 years. The availability bias may result in this investor disinvesting from his suitable multi-asset high-equity fund into a multi-asset income fund instead. This offers less growth potential but a higher degree of capital protection. Both the likelihood and extent to which a multi-asset high-equity fund can outperform a multi-asset income fund over a rolling 5-year period is far greater than what the recent short-term performance suggests. The better investment decision is to remain invested. Tip 3. Avoid knee-jerk reactions to short-term discomfort. It is of critical importance for investors to stick to their long-term investment plan. Trying to time the market is impossible to get correct on a consistent basis. The month ending 24th March 2020 was a turbulent one, down close to minus 30%. In the month ending 24th April 2020, markets showed positive returns in excess of plus 20%. To quantify the opportunity cost of knee-jerk reactions, at what point in the following cycle would you have sold? How long did you stay invested for? Investors who disinvested from the equity market on the 24th of March, just after this year's low point, and invested in cash instead, would have lost out on a recovery of 15,000 rands for every 100,000 rands invested at the start of the period. This is a 15% recovery that was missed. Nedgroup Investments. See money differently.